welcome to BloombergQuint. The uncertainty around the global economy and the Indian economy continues to be very high. Trying to pin down numbers to what's going to happen to the economy is a moving target of sorts. Yet it's important for policy making purposes to get a sense of where the Indian economy is headed. Some estimates coming out from private forecasters, even though the RBI hasn't put out a number, suggest that the hit to growth will be deep. Goldman Sachs is predicting that GDP growth in FY21 could fall to 1.6%, with the caveats that, of course, there is high uncertainty around these estimates as well. But joining us to talk us through what she sees playing out in the economy is Prachi Mishra, Chief India Economist at Goldman Sachs. Prachi, thank you so much for taking the time to speak to us. I am going to start with the very basic question of your forecast of 1.6% and what all you have built into it to be able to get to that estimate.
Good afternoon, Ira. First of all, a pleasure to talk to you again. So I'm not sure if you had the chance to look at our recent report. It's titled An Unprecedented Sudden Stop for India. So our last published forecast as of March 22nd, which is before the lockdown was announced, was 3.3%. And we've done a 170 basis point downgrade relative to that. But just to take a broader picture, relative to early March, when the virus situation was fairly benign in India, we have revised down our growth forecast even more dramatically. So pre-virus situation escalating, our forecast was closer to 6%, more precisely 5.8%. And now we are at 1.6%. So this is a gigantic 420 basis point downgrade. And let me go through slowly what are the reasons behind this sharp downgrade compared to the pre-virus situation. So number one, if you look at our global growth projections, they have been revised downwards dramatically. For example, if we go back to say early January or pre-virus, global growth, we were forecasting around 3.25%. Now our current global growth forecast for 2020 annual average is minus 2%. And just to give you a sense for particular countries, for the United States, we are at minus 6%. For the Euro area, we are at minus 9% for 2020. For the US, we actually have a forecast of 34% contraction in the second quarter. So this would definitely have an implication for India growth. So using elasticities, which we have estimated using historical data for how much Indian growth would react to global growth, this would be a 150 basis point downgrade for India growth. Number two, we've now directly accounted for the effects of the 3-week lockdown. Currently, we are in week 2. So basically, we are assuming that 25% of economic activity would be wiped out in these 3 weeks. And in addition, as seems to be the case now, we are assuming a staggered exit from the lockdown. And this accounting for the effects of the lockdown would amount to a 220 basis point reduction in growth. Number 3, we finally account for some additional investment spillovers over and above the impact through global growth. So in total, if you add each of these 3 factors, we get to a number of 420 basis point downgrade, clearly a giant downward revision in India growth outlook. And if you actually look at it in level terms, this downgrade assumes a 4% contraction in the level of real output in fiscal year 2021 relative to a no virus counterfactual.
Okay. Thanks for that detailed explanation, Prachi. I have had a chance to look at your report, but many viewers and listeners may not have. There is a point where you explain also the sectoral impact, particularly of the domestic factors play out. You point to some of the sectors which could have the largest sort of negative contribution: transport services, education, restaurants, hotels. Could you take us through some of the sectors where you see near complete stop of activity, and then what that will contribute to the decline in GDP estimate?
So, Ira, we've looked at consumption spillovers in detail, sector by sector. So I think the analysis is fairly simple. What we do is for each sector, we assume a certain hit coming from the lockdown and multiply that hit by the sector's share in GDP. For example, as you mentioned, transportation is on one end. We are basically assuming a 95% hit to transportation. If you multiply that by a 10% share of transportation in GDP, that would mean roughly a peak hit to monthly transportation output of 10%. Every month, the lockdown is in place. So this is the peak hit. Then we have education. Education where we assume a large hit because, not as much of a hit as in transportation, but education because there's some online education still going on. We still assume a large hit of about 80%. And if you multiply that by the share of education in GDP, which is roughly 2.6%, you get more than 1% hit to monthly consumption of education. On the other extreme, we have offset sectors like food and health, where we actually assume expansion of 5% and 15%. So overall, this exercise suggests more than 15% hit to monthly consumption every month the lockdown is in place.
Okay, if I just sort of broaden it out, look at it from the perspective of, what contributes to GDP, consumption, investment, government spending, net exports. So on that equation, is it now essentially down to government's contribution, which will hold up, GDP growth to whatever extent possible?
I think this is a very important question, Ira. What is the level of government support we are assuming? And let me say that, while we've deepened the trough in Q1 and Q2 in our growth forecast, let me be very clear that the average of 1.6% for the year as a whole actually assumes a strong sequential recovery in the second half of the fiscal year. And this is based on basically three assumptions. One, that the 3-week nationwide lockdown, which most likely is going to be removed only in a staggered fashion, and the social distancing measures would reduce new infections over the next 4 to 6 weeks, number one. Number two, while the fiscal easing so far has been limited, the last package was 0.8% of GDP or $23 billion, our expectation is of further stimulus by both the center and the states. And third, we expect the RBI to continue with its monetary easing policy along with liquidity infusion measures. So just to make the point that actually the average of 1.6 from the trough assumes a strong quarterly sequential recovery in the second half of the fiscal year. And that would rely on all these three assumptions I've made, and the most important being that the nationwide lockdown and the social distancing measures would actually reduce new infections over the next 4 to 6 weeks, in addition to support from fiscal and monetary policies.
Okay, I'll come to the policy bit in a minute. So quarter-wise, what are your projections? And there are two schools of thought, right? That how quickly is the comeback? Firstly, if one sees a staggered exit from this lockdown, it may be a longer period where there is a continued hit to activity, but also, sort of intangible questions like how many firms actually can't survive this period? What happens to consumption after wages/income are impacted? Those are the intangibles. But what is your sort of quarterly expectation of how growth plays out?
Ira, on the quarterly expectation, we've done a simple exercise. Again, assume that, for example, in Q1 of calendar year 2020, assume that 25% of overall activity is wiped out for 1 week. And in Q2, 25%, another 25% is wiped out for 2 weeks. This is just assuming the 3-week nationwide lockdown. And if you translate these numbers into Q-on-Q annualized, they basically mean a contraction of 8 percentage points in both Q1 and Q2. So what does it mean is basically what we were assuming a pre-virus situation. For example, for Q1, we were assuming, I think, around 6% Q-on-Q annualized growth. That would come to close to minus 2%. For Q2, I think we were assuming 8%. And that would 8%, or I don't remember the number exactly, but probably after the virus, this would come down to minus 4%. So right now, Q-on-Q annualized, we are assuming close to minus 2% in Q1 and minus 4% in Q2. So let me just these are fairly conservative assumptions. In other countries, clearly our trough in Q1 and Q2 go in double digits. So I have to say that risks to these numbers are in fact if anything, risks to these numbers are to the downside. And there are two kinds of risks. One is that the trough can actually be deeper, which is the question you asked on Q1 and Q2. And number two, I think it's more that the recovery itself could be delayed, meaning in Q3, or delayed or more muted than what we are assuming in our growth projections. So of course, I think as data comes in on the impact of the lockdown and economic activity, and there's more clarity on how the staggered exit from the lockdown will take place, we'll have more clarity on both whether the trough is likely to be deeper, and number two, for the recovery, whether it's going to be slower or faster in the second half of the fiscal year.
Okay, understood. Thanks so much for explaining those numbers. Prachi, now a few questions on policy. So I think you're saying you are assuming some fiscal support even beyond what has been announced, because, at least if one looks at it in comparison to what other nations have done, it may not be the best comparison, but, the package is still relatively small. Can I ask you whether you have a sense of how much fiscal support is feasible in the Indian context? And I ask that within the usual, limitations of borrowings, market, access to funding, etc.
Ira, I think this is again a very important question. I think we've been saying this for a while, that India does not have much fiscal space. And if you look at our preferred measure of headline fiscal deficit, that is a public sector deficit net of asset sales, India's fiscal deficit is close to 10% of GDP, and it remains the highest among emerging markets. And why is this important? Is number one, I think three reasons. I would say one is typically fiscal and external instability in India have been correlated. Number two, I think interest payments are high. For example, if you look at the central government fiscal deficit, 95% is interest payments, and those crowd out productive spending on health, education, etc. And then there's a standard crowding out argument. So a combination of all these imply that India may not have that much of a fiscal space. However, what is important to note at this juncture is that these are more medium to long-term arguments. Right now, the economy, both global as well as domestic, is facing an unprecedented shock. And unprecedented shocks do require unprecedented response. I think lack of fiscal space in India basically implies that India perhaps cannot have a magnitude of fiscal response of 10 to 15% of GDP, like many advanced economies are doing. However, what I would like to stress in the Indian context is that more than sheer magnitudes, what is really important is that fiscal response has to be temporary, it has to be targeted, it has to be very carefully calibrated and properly executed. And, so basically, in my view, I think there are two forms which fiscal stimulus can take, and it's already ongoing in the current fiscal stimulus package, I would say. Most importantly, in a global health crisis and an Indian health crisis, I think the allocation for the health sector has to increase urgently. And that allocation has to go towards, maintaining essential supplies like foods, drugs, and utilities during the lockdown phase, which would actually help in enforcement of the lockdown itself, for speedy and effective testing, and for building capacities more generally, for procuring hospital beds, ventilators, isolation beds, stocking up inventory of key medication. I mean, this is a public health crisis, right? Therefore, public health system would have to be at the forefront to fight this. And just to give you some sense of the numbers, public health spending to GDP ratio in India is less than 1% based on WHO latest available data we have. If you compare other emerging economies like South Africa, Brazil, etc., it's 4 times as high. So this is number one. I think the fiscal stimulus has to take a form of allocation to the health sector, which is already happening, but that probably has to happen more. And number two, I think support to households and to SMEs in particular to deal with the crisis. Again, the last package which was announced focused on households and farmers. I think one area where more could be done is to support SMEs. The small and medium enterprises have been hit by several shocks, one after the other, and they have to be revived and kick-started for the recovery to get underway.
Some form of support from the center may be needed to states as well. Prachi, it's very clear that states who are at the front lines of fighting some of this may not have adequate resources or flexibilities within their budgets to deal with themselves.
Absolutely, a lot of these, subjects are actually come under the state government. I think enforcement of the lockdown in particular states, even, health provision of essential health supplies, majority of this actually comes under the state, under the state responsibility. So transfers to the states, I think, will have to go up. And I think, again, as I said, what is important is that it's properly executed. So it's actually spent on, both health sector allocation as well as to support households and SMEs.
On the financing side, Prachi, you did allude to this perhaps by saying that measures should be temporary even if required at this point in time. Do you think the RBI will have to step in either through large open market operations or the holy grail of direct monetization has been talked about? I'm not asking for a view, but do you think at this stage one would have to sort of be open to some non-business as usual options?
Absolutely, Ira. As I mentioned, this is an unprecedented shock globally. So I think extraordinary policy responses will have to be thought through and will come. We will see more of it going forward. Let me point out that one has to understand that the shock is intrinsically different this time around. So one key difference between this episode and some of the earlier episodes is that this fear and scare factor among citizens was clearly not prevalent in India during any of the previous recessions. For example, during the global financial crisis, if you asked a person on the road, he would not even have heard about it. The COVID-19 crisis or the response to that crisis actually represents a unique physical constraint on economic activity that is unprecedented globally in post-war history. And when the constraint is physical, sharp quarterly contractions are highly likely. So therefore, I think extraordinary responses by the government as well as the central bank are of course, I think, most highly likely. And we should see more of it going forward.
Prachi, as things stand right now, based on what we've already heard from the RBI, the rate cuts, the sort of liquidity, throwing liquidity literally into the system, plus some forbearance measures, what do you think the role of these is going to be? We were speaking to somebody else earlier, said that a lot of this will start to play out when productive capacities come back on stream. Right now, there's sort of an insurance to the economy rather than a support.
Right. I think the role of the center. Let me just step back and say two things, Ira. One is, given that this is a global health crisis, as I said, the first line of defense has to be, increased to prevent, the further spread of infections. So health, dealing with the health sector has to be the first line of defense. Macroeconomic policy, whether it's fiscal policy or monetary policy, has to be more the second line of defense. And, of course, I think RBI has, and if you talk to global investors as well, I think RBI has come forward and taken a number of measures. For example, it cut interest rates by 75 basis points in its ahead of schedule MPC meet and took a lot of liquidity infusion measures, as you pointed out, CRR cut, TLTRO, reduction in MSF rates. We do expect, RBI to reduce rates further. We see scope for them to reduce rates by another 50 basis points between now and end of Q3. And this is basically because I think headline inflation is likely to come down and risks to our growth forecast, as I pointed out, despite the sharp downgrades, still remain to the downside. And third, I think the RBI's forward guidance, which was provided clearly by the RBI governor in the last press briefing, does suggest space for further action, which could include interest rate cuts, but other extraordinary actions as well. And even if we look at our estimated monetary policy reaction function, we clearly see predicted interest rates based on our framework to decline further, because output gaps are estimated to widen and headline inflation is likely to come down. And this would also be consistent with our forecast for the Fed to keep rates currently at very low levels into 2022.
Prachi, the other issue is that, look, this is not a financial sector crisis first, but it has the potential to turn into one, particularly in India, given that, we were always already grappling with weak balance sheets on the shadow banking, the NBFC side plus the banking side. Do you see that as an incremental fear, which then obviously hurts the economy, given that we are a very heavily bank-run economy?
Yeah, I think again, if you look at our growth forecast, Ira, as I said, if you look at this downturn, the 1.6% growth for FY21 would be deeper compared to, most widely perceived recessions in India. What India experienced in 1970s, 80s, even in 2009. However, in our current forecast, it's not as bad as, for example, the deep recession in 1979, where growth was like minus 5%. And we are, in fact, even forecasting it to be marginally better for now compared to the 1991 crisis. I think 1991 we were at 1.1% growth. I think your point about I think your point is, if I may rephrase it, is about initial conditions. And the point is important about, in the role of policy as well. So if you look at the global financial crisis, actually, despite it being a financial crisis, one important difference was that India went into the global financial crisis with much stronger initial conditions. This time around, as you pointed out, due to financial sector issues and due to other issues as well, I think the initial conditions are much weaker. So India was already just beginning to show signs of coming out of a significant and continued slowdown, which started, in our view, since January 2018, when this new crisis hit the economy. So I think the overall support, that's why I think from on banking, financial sector, macroeconomic policy support has, given that the initial conditions are actually weaker, probably the policy support in all these areas has to be much larger, and which pertains to the financial sector, but more generally macroeconomic policy response as well.
No, that's very well rephrased. Thanks so much for that. Prachi, I have one last question, and this is on the external trade front, but also on the capital flow front. Sorry, I'm combining those two questions, although I know they're entirely different. So on the trade front, what are you anticipating? Exports will obviously take, a significant hit, but what about the supply chain disruptions on the import side? And on the capital flow side, do you continue to see that as fairly sort of, volatile environment? I know we've seen a slight stoppage in the large sort of exits we had seen from EMs, but it would be tough to take a call saying that phase is over and we would now return to inflows.
Look, on the external sector, I think if we look at above the line era, basically the current account deficit, our forecasts are fairly benign for now. Given where oil is from 65 to 35. And weak economic activity, which means lower non-oil imports. I think our current account forecast, despite exports being weak, despite accounting for exports being weak, and not only exports being weak, remittances being weak, overall, I think above the line or the current account deficit forecasts are fairly benign. It will be less than one. Current account deficit forecast for FY21 is less than 1% of GDP clearly, and maybe more towards the left-hand side. I think the question is on below the line, which is capital flows. And clearly, I think over the last in March, India, if you combine debt and equity together, I think we've seen outflows of roughly $16 billion. And the outflow in March itself, it's higher than the entire outflows we saw in 2018, for example, which was a difficult year for EMs more generally. But let me say that if you look at the INR, for example, I think the INR has weakened about 8% since January. However, if we zoom into the last 2 weeks, INR has actually outperformed, some of the other currencies like IDR, Thai baht, Korean won, and also some of the other emerging economies like Brazil, South Africa, Turkey. And the weakening has been correlated with FII outflows. But if you talk to global investors, at this point, I think most global investors are treating EMs as a basket. And if anything, India's macroeconomic position looks better than, say, back during 2013 taper tantrum. For example, inflation is now projected to be somewhere around, for FY21 average, 4.5%. Current account deficit, as I said, fairly benign, 5 times more in 2013. So, and reserve position is fairly comfortable. So bottom line, I think on the external sector, above the line, I think the current account deficit forecasts are very benign. On the capital account, yes, we've seen portfolio outflows. FDI will be affected, but it should still be sufficient to offset, the current account, the benign current account deficit. And on the INR, actually, while we do see it further weakening in the short to medium term a little bit more, I think over the 12-month horizon, for all the reasons we mentioned, all the reasons I mentioned, we have INR coming back to its levels of 71, 72.
All right, Prachi, just leave us with the last word then, even if in summary, of some of the most immediate priorities that you see for policymakers here in India, or some red flags that you would like to see addressed with some immediacy.
So, Ira, on the red flags, I have to say that, while our new forecasts take into account the 3-week nationwide lockdown, and global growth downgrade, and therefore we have a deeper trough in Q1 and Q2 compared to the pre-virus situation. I think the average of 1.6% is still assuming a strong sequential recovery in the second half of the fiscal year, based on the 3 reasons I mentioned. The 3-week nation lockdown, fiscal, expectation of further fiscal stimulus by both the center and the states, and not only the quantum, which most market participants tend to focus on, but also the quality of fiscal support and the execution of fiscal support. And third, continued policies by the central bank in terms of monetary easing, along with liquidity infusion. And risks to this growth outlook are still skewed to the downside because of, again, there are definitely further downside risks to our global growth projections. And number 2, our assumptions on the effects of the lockdown and staggered exit are fairly conservative. There should be more clarity on this going forward as more data becomes available in terms of the impact of the lockdown on activity, as well as on government policies in terms of how will we exit from the lockdown. And overall, I think the risks are for the trough to be deeper. I think if the rate of infections do not come down in line with our expectations, and for the recovery to be slower if policy support is not as aggressive as we are expecting. And on policies, let me conclude by saying, I think, as just to repeat myself, I think this is a global health pandemic and a domestic health pandemic. I think the first line of defense has to be in the health sector in terms of controlling the spread of the virus. Some of it is already being done. I think we are going to see more of it going forward. And the second line of defense will be macroeconomic policy response to cushion the negative effects on the economy.
Right, Prachi, thanks so much. That was a very educative conversation with all the numbers detailed out. Prachi Mishra of Goldman Sachs. Thanks so much for watching BloombergQuint.
The union to secure your future is here. Andhra Bank and Corporation Bank are now Union Bank of India.